Everybody, welcome to our discussion on this topic, which is impairment of assets. Friends, one of the definitions that we want to kind of begin our discussion on this standard is to look at the meaning of impairment loss. Right? The standard has given this definition to us, and it says that impairment loss is the amount by which the carrying amount of the asset exceeds its recoverable amount. Right? When I say I'm looking at an asset that is shown in my balance sheet, whatever value at which it is shown in the balance sheet reflects its carrying amount, right? And I would need to assess whether that carrying amount is more than the amount that I can recover from that asset, right? That's the crux of this particular definition in the standard as well. Of course, we are saying that if the carrying amount is more than the recoverable amount, we need to book a loss, naming it as impairment loss. Okay, so what we're going to do is basically try and understand these terminologies better in terms of what is probably a carrying amount and what is probably a recoverable amount. Okay, so if I say I'm looking at carrying amount, think of it like this. I purchased a machine for 100,000. Okay, let us say that the expected useful life is 10 years. All right, if I say that salvage value is nil and I'm using a straight line method here. Okay, so under cost method, the carrying value for this asset will be on day one 100,000, assuming this also to be the fair value of that asset. Okay, at the end of year one, it will be 90,000 because the life is 10 years. There is no salvage value. I'm using a straight line method. There would be obviously depreciation of, let's say, 10,000 here. End of year two, it will be 80,000. End of year three, it will be 70,000, and likewise. Right? That's the way I would be able to calculate the value of this asset as it appears in my balance sheet at the end of each reporting date, right? By the way, just to clarify, reporting date is likely to be quarterly basis. Okay, we're just taking the year-end numbers here, but then from the perspective of this standard, it is every time you prepare the financial statement. It does not matter whether you're making the annual reports, annual numbers, whether you're preparing the balance sheets and the pre-enders and the cash flows and statement of changes in equity for the entire year, or are you doing it for each interim period, which is usually quarterly. It can be half yearly also, does not matter. The whole objective is this, that at each reporting date, my carrying value is determinable. Okay, so when I say, for example, at the end of year two, I'm looking at a carrying value of 80,000 here. That is the written down value as it appears in my books. This becomes my carrying value, right? Under the cost method, my carrying value of this machine at the end of year two is 80,000 here. Quite logical, right? That's something in any case we would have known even before. But let us say at the end of year 2, the company decides to revalue the machine. Okay, so that option exists. The company takes that option and now says the revalued amount is, let's say for the sake of argument, is 120,000. Okay, right? That means under the revaluation method, my carrying value now, or the carrying amount, is going to be 120,000 here. Is it okay? Right? So when I look at the meaning of carrying amount, it would mean cost less any accumulated depreciation. Of course, there is more, aspects involved in the definition of carrying amount itself. But then, for the sake of convenience, we are saying cost less accumulated depreciation, or you're looking at revalued amount less any accumulated depreciation after the revaluation has happened. Right? So, for example, now if I say that this is the revalued amount at the end of year 2, and let us say for the sake of it, at the end of year 2, the remaining life is still expected to be 8 years, right? So originally when we purchase this machine, we assume that it is going to be used, the economic life of the machine is going to be 10 years. We used it for 2 years and we revalued it as 120, and we are saying that yes, our original estimate remains same, right? Our original estimate remains same, that automatically my remaining life is 8 years now. Okay, now when I charge depreciation, okay, so my depreciation post revaluation will be 1,20,000, which is my revalued figure, okay, divided by 8, which now is 15,000. Right? What does it mean? It means that at the end of year 3, my carrying value will be 120 minus 15, which is 105. Okay. At the end of year 4, it is going to be 120 minus 30, because each year now I'm going to calculate an annual depreciation of 15. This becomes 90,000 and likewise. Are you fine with that idea first of all? So what all we have said is we've just tried to calculate the carrying amount here. Nothing more than that. Okay, right? So this is one part of this discussion that we have conducted in terms of what is meant by the carrying amount, right? There's still more complexity. I do not want to talk about that at this point in time, but briefly the carrying amount can be calculated either by using the cost method or by using the revaluation method. Whatever value as it lies in my company's balance sheet with respect to that asset reflects its carrying amount. Good so far, right? A very, very brief discussion around this. Of course, what we want to understand now is how do we calculate the recoverable amount. Okay, so that is something that we want to talk about now. We are saying, having dealt with the carrying amount, we are saying that if I have an asset with me So on balance sheet, let's say this machine, which I purchased for 100,000. Okay, we are saying that the recovery from the machine can be made in two ways, right? So either I'm going to let's say use the machine, okay, or I'm going to sell the machine, right? Either I'm going to use the machine or I'm going to sell the machine. I would naturally, as a rational person, I would like to select the option which gives a higher value. Whatever gives me a higher return, I'm supposedly going to take that option. So when I say that, I'm looking at my recoverable amount. Yeah. So my recoverable amount is nothing else but is the higher of something referred to as a value in use, right? Since I use the machine, or fair value less the cost of disposal, right? Something like a net realizable value. Although in this standards context, we don't use the term net realizable value, that is more confined to inventories there. Okay, so if I say I'm gonna use the machine, what is the value I'm going to derive? I would need to compare it if I were to sell this machine outright, if I were to sell this machine right away. So what is the fair value? What is the market value that I'm going to get by selling this machine? But of course there could be some direct costs that I need to incur to be able to sell this machine. Okay, so I take the higher of the two, and that is something which is going to be my recoverable amount. All right, now of course what we need to now understand as to what is meant by value in use. Okay, if I say the machine has (10) years of remaining useful life, right? Then naturally I expect to, let's say, use it for production purposes. Okay, and I will be able to generate cash flows over that remaining life. Okay, right? I would use it for production, generate cash flows over the life. What we are saying here is that take the present value of these cash flows, which means that we need to do the discounting of these cash flows. We have suddenly started talking about an investment appraisal exercise. We have started talking about a capital budgeting exercise here. Okay, so when I say that I'm showing this machine at 100,000, this machine might be used for business purposes, do the production, sell those goods in the market, create cash by selling those goods in the market. We need to take the present value, the discounted value of those cash flows to arrive at the value in use. Okay, so we are using that concept here. Okay, let us say, for the sake of argument, we get a net present value of 105,000. Okay, now before I get into the fair value less cost of disposal, it does not matter how much that comes to, because if I say the carrying amount is 100,000 and my value in use is 105,000, it safely means that the carrying amount is lesser than the recoverable amount. So 100 of course is less than 105, which means that in this scenario there is no impairment loss. Right? I do not have to check the other calculation at all. Are we good on that? Yeah. But let's say for the sake of argument, here this value comes at 85,000. Okay. Now why it would be 85 when I'm already spending 100,000 on day one? Certainly, why should I say that it is 85,000? I'm going to talk about that in a minute. Right? But broadly, if this is 85, I might need to assess the other value also to check if there is an impairment, and if yes, how much is the impairment loss. Okay, so if I say that today if I were to sell this machine, I'm going to only receive 95,000. All right, that means what? It means that I will take the recoverable amount of 95,000, the higher of the two figures, right? So my carrying value or the carrying amount is 100,000 and my recoverable amount is 95,000. Of course, 100 is greater than 95, which means that there's an impairment loss of 5,000 that I need to account for. The way I do the accounting is debit impairment loss, credit machine 5,000 here, right? Of course, what we need to do is spend a lot of time understanding the concepts of the value in use. How do we derive these so-called as cash flows? How do we discount this? What is the discount rate that we are supposed to take? Okay, what are the assumptions that we need to make on this? And then also discuss briefly with respect to what is the meaning of, let's say, fair value, and what are the cost of sales or cost of disposal associated with that, right? But broadly, just to go back to the definition, if my carrying value is more than the recoverable amount, that results, the difference is actually the impairment loss that I need to account for in my books immediately. Prudence concept works here, right? The entire standard is all about prudence concept, the principle of conservatism, as we commonly talk about that as well. Okay, so we're going to spend some time later understanding more on the value in use, the fair value in use, or fair value less cost of disposal. Also talking about why does impairment take place, and how do we deal with impairment losses. Let's say if we are using, remember we talked about the carrying value where we said revaluation method can be used, right? So how do we deal with impairment losses in those scenarios, right? Specific guidance later on impairment of goodwill as well, something that is even more complicated. We're going to spend some time later on that as well, but this is where our impairment losses understood and measured, right? So that is something that we want to talk about in this particular lecture. Do keep watching these lectures, and do subscribe to our channel. That is ABC Learning. Good day, all the very best, and do well. Take care.